Welcome back to the Deep Dive. Today, we are cutting right to the core of Bank of America's Q4 2025 earnings call. And this one was a real exercise in, well, cognitive dissonance. Okay, let's just unpack this immediately. This was such a classic beat the numbers, lose the day scenario. And for you listening, understanding why the market sells off on what looks like fantastic execution, that's the real mission here. The numbers drop, the stock gets a little pop, and then it just air rushes out of the balloon all day, closes the session down about 3.8% on extremely heavy volume. Why the huge disconnect?
It's fascinating because if you just look at the quantitative snapshot, the historical numbers, it was unquestionably solid. I mean, against consensus, they delivered.
Right.
Grape earnings per share came in at 98 cents. That was a 2-cent beat versus the 96-cent consensus estimate.
Okay, a clean beat.
And revenue was also a clear beat. It came in at $28.4 billion. That's net of interest expense. And it easily cleared the $27.94 billion expectation.
There's solid growth, too.
Oh, yeah. Revenue grew a solid 7% year over year. That led to net income of $7.6 billion, which is, 12% growth year over year. The execution was textbook. But the market's reaction, it just screams that sentiment, high expectations, and this is the big one forward guidance uncertainty, were prioritized over this quarter's delivery.
That sentiment shift is just so critical. It suggests investors were holding the stock for a perfect report and perfect guidance, which, in this macro climate is almost impossible. The CEO, Moynihan, and the whole management team really hammered home their core operational drivers, almost like they were saying, look at what we can control. Let's start there with those dual levers, net interest income and operational efficiency.
They certainly did. And let's clarify net interest income, or NII.
Right.
When analysts look at BAC, they focus on fully taxable equivalent NII.
Right.
It's the core engine, the difference between what they earn on loans and pay on deposits. And that fully taxable equivalent part just adjusts for certain tax-exempt income so we can compare it fairly across the industry.
So that's the real measure of their core lending profitability. How did it look?
Well, FTE NII was $15.9 billion, a very respectable 10% year-over-year increase, actually slightly better than even their own models predicted. But the deeper story here, the more structural one that management is, I think, desperate for the market to appreciate, is the operating leverage.
330 basis points of operating leverage in Q4 alone. I mean, that sounds great, but what does that mean for the average listener in terms of future profit?
It means they're growing revenue significantly faster than their expenses. Operating leverage is the key to expanding margins. And for the full year 2025, they achieved 250 basis points of leverage. And the proof is right there in the efficiency ratio. It dropped to 61%. That's a 194 basis point improvement.
61%.
61% is excellent for a massive institution like this. It means only 61 cents of every dollar of revenue goes toward running the business, leaving 39 cents for profit. The lower that ratio, the leaner the ship.
That kind of cost discipline, while still growing the top line, is extraordinary. But given that the CEO is still bullish on GDP growth, why spend so much time talking about expense control? Doesn't that sort of signal a lack of confidence in top-line expansion down the road?
And that's the critical tension point. Management argues they are preparing for all macro scenarios by hardwiring this efficiency. I mean, they held headcount flat for the entire year.
Flat.
And that's despite continuing heavy investment like hiring 2,000 college graduates right into the system. They're doing it through productivity gains, mostly driven by AI and digitalization. They specifically mentioned their AI agent, Erica, which handles massive volumes of customer interaction and operational support. It streamlines things that historically required thousands of human teammates.
So it's an engine replacement. You're freeing up human capital for higher value role.
Exactly. They get repositioned into client-facing roles, which drives growth and at the same time reduces that efficiency ratio.
It's just wild how fast banking is moving toward AI for those back office functions.
Okay, so moving to the balance sheet, the capital and credit story was just as strong.
Absolutely. The bank has an exceptionally comfortable capital position. Their CET1 ratio, that's their common equity tier 1, a key measure of bank stability, is at 11.4%, well above regulatory minimums. And they were aggressive on capital return. They gave $8.4 billion back to shareholders, mostly through $6.3 billion in buybacks.
In credit quality.
Astonishingly good. Provision for credit losses actually declined quarter over quarter to $1.3 billion.
It declined.
And the net charge-off ratio fell to a historically low 44 basis points. I mean, that metric just speaks volumes about the health of the consumer and small businesses they serve.
Wait, hold on. Before we get to growth, they had that weird accounting footnote. What was that all about? The reclassification?
Ah, yes. It was a very technical note. It concerned the accounting method for certain tax-related equity investments. Management stressed the impact on overall net income was, quote, insignificant.
So not a performance issue. No, not at all. It just required retrospective revisions of prior periods for comparability. Essentially, they just moved how certain tax benefits were presented between different lines on the income statement. It's a cleanup job for investors.
Okay, so the plumbing is sound. Let's look at where the revenue is actually coming from, the organic growth drivers. Because efficiency is great, but you need to see that underlying business health.
And the consumer engine continues to be a rock-solid foundation. They just delivered their 28th consecutive quarter of net growth in consumer checking accounts.
28th, so that's 7 straight years.
7 straight years. Think about that consistency. They added 68,000 net new accounts in 2025. And consumer net income grew 17% in Q4. It just confirms the health of their core deposit franchise.
And what about the high net worth segment, Global Wealth and Investment Management, or GWIM? That's usually a good leading indicator of client confidence.
Exactly. And GB is showing clear momentum. Their return on allocated capital, or ROAs, it improved sharply to 28% in Q4. And the pre-tax margin is climbing solidly into the high 20s. Crucially, total client wealth flows, so that's new money coming into the bank from wealth management and consumer investment products, reached $115 billion for the full year. That shows confidence.
Confidence in the market and in BAC as a steward of that capital.
Right. Meanwhile, the market-facing side, global markets and investment banking, showed resilience in what was a pretty mixed year.
What were the standouts there?
Global markets had a record year for sales and trading. They hit nearly $21 billion in revenue. Q4 sales and trading was up 10% year over year, and that was driven significantly by a 23% surge in equities trading.
23%.
Mostly out of the Asia-Pacific region. That equity surge is a great sign of increased volatility and institutional engagement. And then there's investment banking, which was soft earlier in 2025. It showed a dramatic pickup. Management reported that fees in the second half of the year were 25% greater than the first half.
Which signals that clients have finally adjusted to the new tax and regulatory environment.
Exactly. The pipeline remains robust.
So, if execution was clean, capital was ample, and the core businesses were all growing, why the 3.8% sell-off? This brings us to what the street was really listening for, guidance, and sensitivity to potential Fed rate cuts.
This is where that strong internal narrative just collides head-on with external macro fears. The bank maintained their full-year 2026 NII growth outlook of 5 to 7%, and they're projecting Q1 2026 NII growth around 7% year over year.
So they're factoring in rate cuts and are still confident. What gives them that confidence?
It's the structural tailwind of fixed asset repricing. This is a massive multi-year driver for them. They have somewhere between $12 to $15 billion in fixed-rate assets. Think mortgage-backed securities, older mortgage loans, that are expected to roll off the balance sheet quarterly.
And these are all low-yielding assets from years ago.
Very low yielding. And as they mature, they get replaced by new assets yielding 150 to 200 basis points higher. Or that cash is used to pay down expensive short-term debt. This schedule acts as a huge buffer against rate cuts.
But the market fixated on one terrifying number, didn't it? The rate sensitivity calculation. This is why portfolio managers panic.
That's the single data point that torpedoed the stock. Management quantified it. They said a 100 basis point instantaneous drop in rates could decrease NII by $2 billion over the next 12 months.
$2 billion.
And since the stock's run-up was largely based on that higher for longer rate thesis, any threat to the core NII projection just triggers immediate algorithmic and sentiment-driven selling.
The market essentially priced in that 100 basis point cut on the spot.
Did management back off any of their long-term targets in response to this?
Quite the opposite. They reaffirmed their medium-term goal to reach the lower end of the 16 to 18% return on average common equity, or ROAC, range within 8 to 12 quarters.
And ROAC is a key metric for shareholder returns, a huge one. And reaching that range requires consistent NII growth and that sustained operational leverage we talked about. Furthermore, CEO Moynihan remains explicitly, quote, bullish on the U.S. economy in 2026. He's forecasting U.S. GDP growth at 2.6%.
Still, there was another cloud that appeared during the Q&A. It wasn't about the Fed, but about Congress. This renewed chatter about a potential credit card rate cap.
That's a huge sector-wide headwind. It just compresses multiples regardless of current strength. Management argued really strongly that this would lead to unintended consequences.
Their position is that it restricts their ability to price risk, so they'd have to pull back on credit.
Exactly. It would constrict credit availability, hurting the very consumers and small businesses the policy is intended to help. It's a very real uncertainty hanging over them.
So what does this all mean? Time for our segment where we look at the data through a speculative, high-risk lens. This is not financial advice. This discussion is purely for informational purposes, based only on the data from the earnings call. We are in no way suggesting you follow this idea. You should absolutely consult a professional financial advisor. But if we were betting purely on the numbers we just heard, pitting that operational strength against the macro panic, what's the outrageous but plausible trade idea?
The premise is simple. The market sold off because it's aggressively pricing in the full downside risk of rapid, deep rate cuts, that $2 billion NII sensitivity. This trade is a bet that the market is wrong about the speed of those cuts.
Or that the internal execution provides a bigger offset than the market thinks.
Precisely. So the outrageous but plausible trade is a short-term long position on the bank, maybe using call options with an expiration about 90 days out. You are betting against the pace of the Fed and for the continued macro strength that Moynihan is describing.
So you're betting on the CEO's confidence and the bank's internal discipline to win out over external fear.
Exactly. The target would be a quick return to the pre-call valuation, so above $54.54 within 90 days. The catalyst map is twofold. Either macro data comes in hot and delays the Fed cuts, which immediately eases that NII pressure, or the strong operational leverage, those efficiency ratio improvements, and the robust fee growth from investment banking and trading are finally recognized by the street as enough of an offset to any minor NII compression. It's a high-conviction bet on internal execution overriding temporary market panic.
That is a very sharp take, contrasting the operational strength against the policy risk that actually moved the stock. So what are the core takeaways from this deep dive for the listener?
Fundamentally, this was a fantastic operational year. They delivered revenue beats, strong NII, and substantial operating leverage. The long-term multi-year story is still their commitment to generating another 200 basis points of operating leverage in fiscal 26 and driving down that efficiency ratio.
That's the primary value driver, regardless of rate volatility.
It is. That internal commitment is the reliable piece.
Which brings us to our final thought for you to mull over, which will prove to be the stronger predictor for the next 12 months. Is it management's confidence in organic growth and efficiency? Or is it the market's current fear about macro policy risk? Thank you for diving deep with us today.
And remember, this discussion is for informational purposes only.